tax colleagues, it's Audrey on podcast Pajak Tanpa Batas. Today, we'll be discussing about mergers and taxes, from the definition to how to avoid the fiscal burden. For today's episode, we'll be using English for the discussion. Hopefully, the expatriate and the international business school students will find it easier to follow the topic of mergers and applicable taxation. Today, I'm here joined by my partner, Michelle. Hi, Michelle. How are you today?
Hi, Audrey. I'm doing well. Thank you for having me in this podcast.
Okay, let's start from the basics. Yeah. What exactly is a merger?
Okay, Audrey. So, a merger is the process of combining two or more companies into a single entity. Legally, the merging companies transfer all their assets and liabilities to the receiving company, and their legal status ends automatically without going through liquidation. Mergers are typically carried out for expansion, operational efficiency, or to reduce market competition.
Okay, so does this means that mergers are not just about business, but they also have legal and financial implications?
Exactly, and just as important, the tax aspects.
As far as I know, there's not just only one type of merger, right?
Yes, mergers can be categorized into three types. First, horizontal merger, when two companies in the same industry offering similar products or services merge to control the market. This creates better economies of scale and reduces competition. Second, vertical merger, when two companies in the same industry but at different production levels merge. Third, conglomerate merger, a merger between companies from completely unrelated industries where a parent company owns several subsidiaries across different sectors.
Oh, actually, I'm quite curious. Why do companies decide to merge?
There are several factors such as to generate net profits through synergy, to control the quality, price, and supply of its products, to reduce risk and stabilize future income streams, and the relationship between the company owner and management, in which the owner grants authority to management to carry out the company's operational activities.
So, in general, there are four factors that influence a company's decision to merge. Yeah. Now, let's get a bit more technical about the recording methods for mergers. How many methods are there?
Typically, there are two accounting methods used in mergers. First, pooling of interest method. The merger is considered a unification. Assets are recorded at book value with no goodwill or increase in asset value. Second, purchase method. Assets are recorded at market value, potentially creating goodwill, which is then amortized. Using the book value method may help avoid income tax on the gain from asset revaluation. Meanwhile, market value may lead to lower taxable profit in the future due to goodwill and larger depreciation from increased asset values.
Okay, so means that it depends on what method chosen, yeah. It can save tax or even be taxed.
That's right. That's why tax strategy is crucial before a merger.
Okay, so before the merger process, companies ideally should also conduct the tax due diligence, right?
Yes, exactly. The purpose is to avoid tax issue during the merger. Tax due diligence is a comprehensive evaluation of company tax compliance. It assesses hidden tax liabilities, fiscal corrections, tax receivable or payables, and supporting documents like tax invoices, tax returns, and payment slips.
How long actually does a merger usually take, and what steps are involved?
A merger typically takes around 30 days to complete regulatory requirements. However, it may take longer depending on negotiation and due diligence. Generally, the merger process consists of three main phases: pre execution, execution, and post execution.
Wow, so it's quite a long process, yeah, for a merger.
Yes. First, in the pre execution phase, the company strategizes and identifies merger targets. Second, in the execution phase, focuses on combining and integrating companies, including due diligence, valuation, negotiation, deal structuring, and accounting. Third, in the post-execution phase, the company manages post-merger integration and exit strategies through defining and assessing the new entity and fine-tuning the merger process.
But are there any problems or issues that might happen during the merger process?
Yes, mergers can lead to several issues such as accounting and tax challenges related to the chosen method, monopoly issues, and internal issues such as share structure, shareholder rights, board authority, assets and liabilities, licensing, etc.
All right, now let's talk about the tax aspects. What should companies look out for?
In mergers, company must be mindful of several tax aspects. First, income tax. According to Article 10, paragraph 3 of the Income Tax Law, asset transfers due to mergers are generally valued at market value. The difference between market and book value can be subject to income tax. However, under the Minister of Finance exception in the same article, mergers can be valued at book value and be tax-free. This is further regulated in Regulation PMK 81 of 2024 regarding requirements and procedures. Second, VAT, or value added tax. Mergers are not subject to VAT as long as the transaction is between taxable persons. If one party is not taxable person, the transaction is still subject to VAT. Plus, final income tax and BPH-TB or land and building transfer duty. In principle, asset transfers must be followed at market price. Any gain is taxable. In addition to final tax, mergers are subject to BPH-TB at 5%, as stated in Article 6, paragraph 2K of Law number 2 of 2000.
That's quite a comprehensive explanation. Perhaps do you have any strategies for tax efficiency?
Yes, to avoid high tax burdens, here are some strategies. First, use the book value method to defer or avoid tax on asset revaluation. Second, apply to the tax office if you want to use book value for asset transfers. Third, ensure all merging entities are taxable person to avoid VAT. Fourth, complete documentation and maintain transparency during due diligence. Fifth, choose the right merger method.
What a thorough explanation. Okay, so to sum up, mergers don't just affect business strategy and management, but also bring important tax implications. Because that's why it's very crucial for any company considering a merger to understand that the relevant tax regulations. Because with the right strategy, proper recording method, and proper tax due diligence, company can avoid fiscal risk and maximize tax efficiency.
Absolutely right, Audrey.
All right, that wraps up this episode. Thank you so much, Michelle, for your insights.
My pleasure, Audrey.
And to all of our tax colleagues, don't forget to like, comment, and subscribe to our YouTube channel. See you in the next
Yeah.
episode.